Great. Well, good morning, everyone. I hope following Lord Bourne's outline of the challenge of the global climate change deal that your brains are all now fizzing and you're awake. I was one of those people who was awake at 3:30 this morning, and you will know how alert I am because I'm up here in front of you, but we will also know how alert you all are in the room and online because we'll see from the questions, which I encourage you to be thinking about and then to send through, so they'll pop up on the iPad. You can use Pigeonhole, so please start thinking of those, and we'll certainly allow some time for those at the end. Let's start with some good news. So in the FT, just 2 days ago, the G20 were coming out as being rather more bullish on growth than we might have expected, which is fantastic. No mention, however, of China, and I think actually more pertinent to this discussion, no mention either of productivity, and yet some might say there's a global productivity crisis. Productivity has been growing really slowly over the last decade. I think it's growing more slowly than any time since the turn of the millennium. In developed countries like the US, in Europe and in Japan, labor productivity is pretty much stalled. And even in China and in Brazil, productivity is going at a slow pace. But wait, I don't just come with good news and then slam you with some bad news. There's some good news again, and the good news is about energy productivity, which actually has been on a steady increase around 1.3% per year. And even more good news is that the G20 want to talk about this. So we have assembled you a fantastic panel of experts who are in different ways involved in what's going on with the G20 discussions. They're going to share with you some of their insights and some of the really sort of up-to-the-minute thinking on what's going on. Each of the panelists is going to bring a different perspective to this. We've got a private sector perspective, we have a G20 Secretariat perspective, we have a public bank perspective, and an NGO perspective. So I'll allow our panelists just to say a couple of words to introduce themselves and their organisation before we get stuck into the discussion. So Benoit, Lebot, do you want to just say a few words to introduce yourself?
Thank you, Dan, and good morning, everyone. My name is Benoit Lebot. I work for the International Partnership for Energy Efficiency Cooperation, the IPEC, an organization based in Paris, a partnership between 16 of the largest economies in the world. We have the OECD plus the BRICS as members. Our 16 members are all part of the G20. The mission of the IPEC is in its name, International Partnership for Energy Efficiency Cooperation. We report to the Clean Energy Ministerial for some of our activity, to the Major Economies Forum, and lately to the G20 itself. We work through a series of international collaboration. One of them, the most recent, but maybe the most important, is to work on finance and how can we, through the G20, push countries to enhance the financial flow, the investment in energy efficiency to the scale of what we need.
Thank you, Benoit. Peter Sweatman.
Thanks very much, Dan. My name is Peter Sweatman. I run a business called Climate Strategy and Partners. We've spent the last 7 years focused on the private and public financing questions around energy efficiency. Prior to founding this firm, I was a managing director of a fund that was involved in deploying around €1 billion into climate finance. That fund was called Climate Change Capital. And prior to that, I was part of the mainstream finance world. I'm coming today to share the experience that I've had as the rapporteur of the Energy Efficiency Financial Institutions Group, which for 2 years in Europe brought together 100 organizations, a lot of financial institutions to, in support of European policymakers, debate and consider how to increase energy efficiency investments in Europe. And I'm also delighted to say that I was invited by France and Mexico, who are the co-chairs of the Energy Efficiency Finance Task Group of the G20 that Benoit has just mentioned, and I was invited to join that group and have been working this year with some of those G20 countries, arranging workshops to develop the same issues at a global scale. Thank you.
Thank you, Peter. Gregor Paterson-Jones.
I am Gregor Paterson-Jones. I am from the Green Investment Bank. which is a government-owned commercial financing institution which was set up in response to an identified gap in financing by Department of Energy and Climate Change to meet the 2020 climate goals committed to by the UK government. At the time, the research showed that there was a gap of approximately 150 billion between 2010 and 2020 of infrastructure financing to meet those goals. And it was determined at the time that there was a need for a public institution which was commercially investing in infrastructure projects in the UK that could take the lead and bring in other private financiers into the infrastructure market. So the markets that the Green Investment Bank concentrate on are varied, but they fall into three buckets. Offshore wind is the first bucket, waste to energy and biomass to energy is the second bucket, and the third bucket is possibly the most challenging, and that is energy efficiency. So a little bit about our activities in energy efficiency. I won't go into detail, we'll talk about that later. But energy efficiency from a financier's point of view is not a sector. It is a concept, and in order to invest in energy efficiency cogently from a financier's point of view, you need to either identify a particular sector or technology or style of investment. And secondly, then you need to have a point of aggregation. Energy efficiency technologies and projects are generally very, very small. And you have to find out what is going to be the most efficient way to deploy capital that can bring together a number of projects, either with a common host, a common product, or a common set of investors. Thank you.
Thanks, Gregor. And last but by no means least, Ingrid Holmes.
My name's Ingrid Holmes. I'm a director at E3G and I lead our work on finance. E3G is a small not-for-profit focused on accelerating the transition to a low-carbon economy. Our work on finance has evolved over the last 5 years from an initial focus on the setting up of the Green Investment Bank, which is an idea I developed when I was working at Climate Change Capital with Peter. So there's a lot of synergies on the panel today. And this was really born out of a long-standing understanding that we needed to tackle both the aggregation and the scale issue if we were going to get sufficient funding into energy efficiency. And hence a public bank seemed to be a good response to that and the wider infrastructure financing challenges in the UK economy. From there, we've evolved the focus of the programme to think about public financing choices, smart public financing choices, and how we can use institutions and policy frameworks to leverage capital into the right spaces. And with that in mind, I also, as well as having worked at a bank, have a background working in government and parliament. So it's that synergy between finance and policy that I'm focused on.
Great, thanks Ingrid. That's your panel. So let's just be clear on the challenge before we get stuck in. The energy productivity financing challenge is huge. The IEA says we need 13 trillion invested in energy productivity by 2035 to stabilise at 2 degrees. Currently, we're around 300 million per year globally, okay? So there's a huge gap there. Now, while the G20 is unlikely to designate a specific amount of energy productivity financing, it can give confidence, it can clarify the roles of the different institutions, and it can recognise energy efficiency for the contribution it can make to global productivity. But, panel, is it going to do that? That's my question, okay? That's what you are going to tackle for us this morning. What can the G20 agree? On that note, over to you, Benoit. Take it away.
Well, thank you. First of all, G20 is the next big forum. If you reach an agreement among the G20, you have 80% of the world economy, the world GDP, the world greenhouse gas emission, the world energy consumption, the world energy efficiency potential. So if the G20 country can agree on some policy, some recommendations, some common policy, then we can make a big demonstration that a change can be made at the scale of what we need. You just mentioned some figures from the IEA on the need to scale up investment in energy efficiency. What I have in mind is this assessment from the IEA and also from the UN Sustainable Energy for All. Between now and 2030, for the 2-degree path, we have to double the amount of investment in renewable energy. We have to double, that's big. Over the same period, we have to multiply by 5 the amount of investment in energy efficiency to be on the 2-degree scenario. So we need to do both, of course, renewable energy and the energy efficiency. But the scale of investment in energy efficiency has really to change gears. And last year, Australia was a president of the G20. And they have decided to put the topic of energy efficiency, not energy productivity, but the topic of energy efficiency at the table of the G20. And last November, the G20 decided to have a G20 energy efficiency action plan, proposing 6 work streams on transport, on buildings, on energy efficiency in the industry sector, on appliances, on the power sector, and on finance. And the title of the finance is Enhancing the Investment Flows in Energy Efficiency. And the G20 requested IPIC, the organization I'm running, to coordinate the activity. So we put in place a special task group, a G20 IPIC task group on finance that we call the Energy Efficiency Finance Task Group. And over the past year, since January until now, we have convened a series of high-level meetings between policymakers from the government and the financial institution, representative from the financial institution. The Ministry of Finance, very important, the investment funds, the commercial banks, the private and public sector, and progressively, over the year, this group has produced a series of analyses. We hold workshops in 3 different continents, from North America, Europe, and China, identified a series of themes to be addressed on, to enhance energy efficiency investment. And from the 8th theme that we develop, from making sure that energy is given priority, understanding how we can boost the demand for investment and the supply of investment on energy efficiency. From those 8 themes, we derive a series of 5 principles that we call the energy efficiency investment principles that were presented last week at the G20. And we are seeking the support of the G20 countries, the recognition not only of the work done, but also on the benefits to maybe make those energy efficiency investment principles, the G20 energy efficiency investment principle. And should we get there, we have 1 more month before the G20 energy ministerial, we believe that the G20 will send a signal that in this world, energy efficiency deserves special attention. And we really need to engage this high-level dialogue between the energy efficiency community and the finance community. They have lots of business to do, very profitable business, and hopefully with recognize the G20 energy efficiency investment principle, we can open the door and the mindset of many players in the field, first within the G20, and we send a signal to the rest of the world. So this is, in short, I think, what the G20 currently is doing in the field of energy efficiency and investment.
Okay, thank you, Benoit. Could you just give us a bit more of a flavour about the principles? There was a good explanation of the process there. I know this is all in some ways confidential, but just in a more generic way, what some of the principles might be.
I'm sure if we keep this audience for 2 days in a room, we'll come up with some similar principles. There are 5 principles. The first one is to make energy efficiency a priority, so that in business decision, in investment decision, that energy efficiency is there. Oftentimes we are missing opportunity because there is, no one is thinking about energy efficiency, so make energy efficiency first as a principle. This is number 1. Number 2 is to propose some recommendation to enhance the demand for energy efficiency investment. The third is to enhance the supply. The fourth is to propose some harmonization of the different tools, we need some tools, standards, certification, some specific instruments from the financial institutions so that energy efficiency becomes just easier. All this MRV part that we need in energy efficiency because it is invisible. And we believe that in the field of finance, there is some very specific areas that have been identified as the fact that they are lacking, they don't exist, is seen as a barrier. So the intention is maybe to engage countries to refine those tools. And the fifth one is the collaboration between the public and the private and all the partners. So a series of 5 global principles that hopefully we'll be able to release anytime soon, before the end of, definitely in October, I hope with the exact title of the G20 Energy Investment Principle.
Excellent. Thank you very much, Benoit. And a great segue to Peter, actually, who's going to talk now a bit more about what that collaboration looks like in terms of the role of the private sector and public banks.
Yes, thanks, Dan, and thank you, Benoit, for that perfect introduction. So, of the question that was written in the program, I was asked to address what can we expect from the private sector, having just heard what we are looking to the G20 nations to help deliver. So there are really 5 things I wanted to say. And the first is, I think this question, what can we expect from the private sector, has 2 answers. The first answer is a lot, and the second answer is double that. Because energy efficiency or energy productivity, which for the mathematicians among you is just the inverse, these 2 things are just the inverse of one another, happens anyway at a background rate. All businesses that use energy or that are energy intense want to use as little of it as possible. They want to save costs. As was mentioned in the opening remarks, industry has been improving its energy productivity at a rate of 1.3% per annum for the last 15 years. So the question, I think, in terms of what can we expect from the private sector is, can we expect business as usual, or can we expect more than that? So can we expect the 1.3% annual productivity gains to move to 2.5%? Can we expect European buildings renovations to go from a 1% rate per annum to a 2% rate per annum? Do we expect those renovations to go from shallow renovations, such as just changing the boiler, or to deep renovations that have the potential of reducing the energy demand of the building by 80%? Are we looking for just short-term measures, or are we looking for long-term measures? Are we looking in the industrial setting for 3-year paybacks or less, 6-month paybacks in terms of the economic returns to energy efficiency investments? Or are we looking for 10 years or more, which better match the lifetime use of the industrial process or building? Will we get G20's priority attention? And will, for example, in the case of a particular meeting that I had in China, will the 2 million homes that will be built newly in China be built taking into account the total cost of ownership of the occupants of those homes during their lifetime, and therefore suggest one design of home, an energy efficient design, or will they just be built as cheaply as possible, reducing upfront costs but increasing the overall lifetime energy footprint of those homes? Those are, I think, the questions. And before, thanks in a lot of ways to the European attention, the US attention on energy efficiency and energy productivity, respectively, before energy efficiency was the first fuel, it was certainly the hidden fuel. So I'm sure a lot of you know, when we ask things of the private sector, it is relatively fair for the private sector to say, well, since the 1970s, the amount of output we have from cars, white goods, and buildings and industry per unit of energy used has gone up by a factor of between 4 and 5 times. So we are already, in many ways, on a very energy efficient trajectory. The question, I think correctly phrased, is that enough, or can we do more? And the answer, I believe, is absolutely we can do more. Absolutely, energy efficiency action by the private sector, by the world's investors, by the world's banks, by the finance community if increased to the levels which Benoit has suggested, which is multiplying the activity, the investment activity, by a factor of between 5 and 8 between now and 2035, we will bring multiple benefits, both economic, environmental, and social, to the private to the private sector and to public welfare. So the call for example, doubling global energy productivity, or the targets in a European context for 27% improvement on energy efficiency, hopefully moving to 30% by 2030, in my opinion, are all targets which make economic and social and environmental sense. But I would certainly begin by economic. I think there's nothing about, in all of our interviews with many hundreds of financial institutions around the world, I think nobody doubts that energy efficiency investments are profitable. The issue of energy efficiency investing is making them visible and reducing the transaction costs and engaging more financial institutions who are, frankly, up until now, more used to financing big pieces of kit, such as nuclear power stations or generation stations or even renewables, which is easier to do often than being involved in the intimate details of how a building is managed or how an industrial process works in order to improve its energy efficiency and productivity. So there is the challenge, and what are we doing about it? So in addition to the work which is being led by the IPIC and the work of the Energy Efficiency Finance Task Group, we are managing an energy efficiency investor statement. So what this is the Principles of Responsible Investing, PRI, have 1,400 members, which represents around $59 trillion worth of assets under management. The PRI, together with a process led by our colleagues at the United Nations Environment Programme Finance Initiative, have drafted, in collaboration with the Energy Efficiency Finance Task Group, an energy efficiency investor statement. It is cleverly worded to match precisely the form of commitment which those investors have already made under the Principles for Responsible Investment, except that it brings to focus the profitable and interesting opportunities that they may have inside their existing portfolios for energy efficiency investing. That process has been ongoing for just over a month. I'm happy to say that today we have already $2.55 trillion worth of investors controlling those assets under management in agreement with our energy efficiency investor statement. That number will only go up. That process will continue all the way through to the COP. We very much hope that this signal from long-term investors will show G20 nations just how serious the private sector is about upping the ante and moving and taking responsibility for their commitment to double energy efficiency, energy productivity and energy efficiency. But that's just one of the things that we're also doing. So we're managing that process, and we very much hope that by the time COP comes, we'll have some excellent results there in support of any G20 announcements. Simultaneously, we're working with banks, because of course the financial institution world is heterogeneous. There's lots of different actors, and long-term investors have one particular role, banks have a different role. Next week, we have over 200 banks in the world convening in meetings in Istanbul to discuss precisely this question. What is it that banks, private sector banks, can do to increase energy efficiency investment rates? I'm optimistic and hope that what we'll be able to move out of that is some form of commitment or declaration that will bring banks together to join up their own energy efficiency investment experiences, to learn from one another, and to increase the rate at which bank finance is supporting energy efficiency across the world. We'll see how that process goes. We will report back in the context of the COP and in the context of the activities of the IPIC. And with that, sort of brief overview, I will turn the conversation back to you, Dan.
Great. Thank you very much, Peter. Before we go over to you, Gregor, I'm sure the questions are coming through. Can I do a shout out to the technicians that I don't have the password for this device, so that would be very handy. Over to you, Gregor.
So we talk generally at a very sort of helicopter level about energy efficiency, and I'd like to come down to a particular example to give you a sense of how a financier looks at the market. Before I do that, I want to say that a maturity of a market from a finance point of view has a great effect on how quickly a financing market can make or pass over a benefit to the ultimate consumer. And in terms of the development of a market, at the early stages of a market, the types of investors that are going to invest in a market, an early stage technology or something that hasn't been, a business model that hasn't been proven out, are not going to do it by lending and expecting that project to pay it back. They're going to take a fairly high level of risk. So they're going to want high returns, and in some cases, returns higher than 20%. As you move down to a more mature market, you can bring debt in at a lower cost. And as you get to a very, very mature market, so you can bring debt in at a very low cost, and you can pass it over to scale investors who are investing at very low rates. What that means in very, very practical terms is the effect of financing on the total cost of a project is less and less as the market becomes more and more mature. So where you want to end up from a policy point of view is at a mature financing market as quickly as possible. And in order to do that, you don't need necessarily to reduce the cost of the product. You've just got to prove that the particular project can generate a commercial return and that you can do it at scale. So let's go to a particular example. Energy efficiency, as I said, is a concept. You've got to ground it in something. What is the project? What are you actually investing in? So the Green Investment Bank looked at the market and said, the best way to approach this market from a financier, which is an infrastructure financier, which wants to deploy large amounts of capital, is to try and find a slightly maturer technology and a counterparty and a host that's doing things in a similar way across a number of projects. And the market that we initially focused on was the street lighting market in the UK. Now, street lights are largely owned by local authorities, so you've got a single owner and, in theory, a single contractual relationship. Secondly, street lighting, the lights that are provided for street lights, it's a fairly mature technology. There's relatively little technology risk, and the manufacturer warranties that you'll get in that technology are fairly long. So what does that allow you to do? It allows you to do two things. One, you can lend to a project or lend to a local authority knowing that there's relatively little technology risk, so you're not taking an equity type risk. The other thing that you can do is you can have a common financing proposition across the whole market. There's something like 7.5 million streetlights in the UK. They use between 300 and 400 million pounds of energy a year. We don't know exactly because not each individual light is metered, but that's what we estimate at. And you can save in excess of 200 million pounds per year. Now, that's a significant saving. So what we did then is we looked at the market and said local authorities own these assets largely. Some of them are owned by PPPs effectively in the UK, but largely owned directly by the local authorities. Local authorities are of good credit quality in the UK. You can lend to them fairly cheaply against their own credit. They'll probably pay your money back, and no local authority has gone bankrupt in the past. So what we said is we could lend in a complex SPV-type structure with a relatively high cost of finance, or we could lend directly to a local authority, let them take the technology risk, which is fairly low, and therefore reduce the total cost of finance. So if you're financing something which is, let's say for ease of mathematical calculation, is 10 million per year, and 10 million in total capital cost, and you're charging a rate of 20% per year, very, very quickly, after 5 years, the capital cost equals your cost of financing. If you're able to lend at less than 5%, that goes way beyond 20 years. So what you can do is you can allow, if there genuinely are savings, and in street lighting there are significant savings because you're saving 50 to 70% of the total electricity cost, you can stretch out the cost of financing into a long tenor. So that allows two things. A financier can lend at a very low rate, And they can also know that because the credit to the counterparty is good, they're going to pay that back that money. And suddenly a market is created where you can lend into a market cheaply. It's attractive for the local authorities to do so. And what's happening on a profit and loss basis is they're actually making money out of the project. They're saving more than they're spending on repaying the capital and paying the interest. So why hasn't the market exploded? Suddenly you've got all the components of a market where suddenly local authorities should be running out of the door to get this finance and suddenly change their lighting estate. For two reasons. The first reason is that given budget cuts and given the capabilities of local authorities, there often aren't sufficient resources to develop a good business case. That's the first thing. Now, in order for a financier to be able to lend, they need to know, one, that the money is going to be spent where it's supposed to be spent, and in order for councillors to be able to vote on a particular proposition, they need to be pretty sure that this is going to work. The second thing then is, although it's attractive, and though they can do it, there is some complexity in it. They don't have the resources to develop the business case, but they're not forced to do it. It makes economic sense. You can make money out of a project like this, but they're not doing it. So here are two components of a market where, from a financier's point of view, everything is correct in order to reduce the cost of finance. It can be financed out of the savings, which is the holy grail of energy efficiency, over whatever time period. But the market is not accelerating as fast as it should. So I want to leave you with this thought. It's not enough to regulate that things must happen, and it's not enough to provide the resources for things to happen. You have to do both simultaneously. You have to regulate, and you have to offer, through concessionary finance or some sort of mechanism, the ability to develop a financeable proposition. And if you put the two together, then the market will work. And things are starting to happen in the UK in that sense. There are frameworks of procurement which are being developed for common regions, for streetlights in particular. And there are mechanisms now being funded through the European Union, EDRF, and other funding lines that are providing help to local authorities to do this. So that's one simple example. It doesn't talk about the whole energy efficiency market, but I thought that it'd give you a sensible view of, from a financier's point of view, if you want to push the market forward, what do you need to do?
Thanks very much, Gregor. Really useful, I think, to get that perspective. I'm sure the audience agree. Ingrid, you get the last word, so you can reflect on what's been said and tell us what more needs to happen.
Thank you, Dan. So Benoit said we need to change gears on energy efficiency, and I think that's what we can be asking the G20 to do. And we're building the case at E3G that we can achieve that by making energy efficiency an infrastructure priority. Why would we do that? Well, over the next 15 years, the infrastructure spending decisions made across the world will determine whether we are able to shift to a low-carbon economy in a way that avoids dangerous climate change. With the fragile global economic recovery, infrastructure investment is one of the top issues for the G20 agenda. It was cited as a top priority at the latest finance ministers' communique. So even at a time when public funds are quite scarce across many countries, there is still talk of deploying billions into infrastructure to drive growth. In the UK, for example, although we have an austerity agenda, we've managed to find 15 billion for a road building programme and 35 billion for high-speed rail 2 networks. So there is money for the right projects. And at E3G, we've been building the case that energy efficiency should be included as one of those right projects. Rolled out as a systematic programme of investment, energy efficiency does have the same characteristics as traditional infrastructure. It's long-lasting capital stock, it provides inputs to a wide range of goods and services, and it frees up capacity in other parts of the economy. And as such, it really does need to be treated not as small-scale programmatic spending, but integrated into national infrastructure priorities, funded as capital expenditure. When you look at the amount of aggregated investment needed on energy efficiency, it does dwarf that needed on the supply side. We've heard mention of the 8-fold financing gap that needs to be closed. This could be something transformative. And given the multiple benefits of energy efficiency programs and the fact that it is just the smart thing to do to think about demand and how you can increase productivity when you're doing major supply-side infrastructure planning, we think governments are really missing a trick by not classifying efficiency in this way and involving it in that big economic decision-making process. So our response to this has been to mobilise NGOs and business alliances across the G20 around 3 key asks. These are in the gift of the G20 to fulfil, and they very much complement the work of the Energy Efficiency Action Plan process and the investor statement. What we're asking for is a reclassification of energy efficiency as a public infrastructure priority, an undertaking by the finance ministers to make an assessment of the structural reforms needed to address financing barriers and grow markets for improving energy efficiency. And that is a very generic, all-encompassing term that picks up a lot of the detailed discussion going on now. And to commit to providing sufficient public funding to ensure, particularly in the building sector, but across the board, that everyone can access the financing needed to improve everything from street lighting to buildings. We've got, I think, NGOs from around 13, possibly 15 countries supporting this, and a range of alliances around energy productivity, saving energy, signed up, and we're now moving to gaining corporate support. So anybody who is interested in hearing more about this statement and supporting us, we'd be delighted to hear from you.
Great. Thank you very much, Ingrid. Okay, so we now have about 15 minutes for questions, and we'll go to our pigeonhole first, and then we'll come to the audience. So the question which got the most votes was, which geographical region will be the most sensitive and/or the most pivotal for investments in energy productivity? And I think that's one, at least in the first instance, for you, Benoit.
Well, all countries are concerned about improvement in energy productivity, and I have in mind that despite the huge potential we have in the developed world, moving the emerging countries on the low-carbon path brings some even greater greenhouse gas reduction, for instance. So we have to make sure that the principle, all the change that we want to see in the way energy efficiency is perceived by the financial institution make its way not only in the developed world, so I would say the OECD world, Europe, North America, Australia, Japan, Korea, but we immediately have to make sure that the good practices is also heard and applied in the fast emerging countries. The benefits of working at the G20 is that we have those countries, the country that counts in the world economy around the table. So I would not prioritize. I know also the importance of leading by example, and it is much easier to propose, to show a way to an emerging economies or to the developing world when the example are set at home. So maybe we can have some hope to impact first, to have the change that we want to see absorbed by the developed world, but immediately after that, we need to see China, India, Brazil, Russia move on the same path.
Thanks, Benoit. Any of the other panelists want to give a perspective on that? Peter?
So I think there is a very clear technology story within energy efficiency, and one that perhaps is not as obvious as the technology story that's happened in renewables. So in the last 11 years, when I've been working both with renewable energy and energy efficiency, the cost of solar installations and solar power has gone down, roughly speaking, to 1/6 of what it was about 10, 11 years ago in terms of fully installed. And I don't think that actually any of us in the industry probably would have expected that. But it has happened, and it's generated almost a revolution in some parts of the world in terms of how the future of the energy markets look. with respect of street lighting, to give you an example, so I'm going to answer the question by saying that I think it's developing countries, and particularly the rapidly industrializing ones, that are the key players for energy efficiency and energy productivity. India, in August of 2014, the Indian government announced that it was going to change all of its street lights for LEDs. The result of that announcement was not just that when they began to tender in an organized fashion for the replacement of groups of hundreds of thousands of bulbs and installations to LEDs, they found that the competition that created and the size of that potential market caused the Indian-produced LEDs to drop to 1/6 of their cost, fully installed, in a period of 6 months. LED technology has the capacity, as just one example of energy efficiency, as energy-efficient technologies, has the possibility to allow for leapfrogging and to allow for industrializing countries not to have to pass through a high-carbon, high-energy-intense phase and to move quickly to an energy-efficient and energy-productive phase. I think it's the streetlights in India, it's the 2 million new homes in China that, well, when built and when they become, as Ingrid points out, the infrastructure of tomorrow, that will determine our energy future, and that will determine whether we win or we lose the energy productivity challenge.
Thanks, Peter. I think a really practical and really optimistic example there. Let's open up to the audience. Do we have any questions from the floor? Yes, the gentleman here in the middle. There's a microphone coming.
Hi, Tim Crosland from the COP21 Support Network. One of the major impediments to negotiations at COP21 is around financing for developing countries' adaptation and mitigation efforts. And I just wondered what, particularly listening to Peter just now, what is the potential to align this call for financing for energy productivity to the call for developed countries to raise capital to support developing countries' mitigation efforts? Because it sounds as though these could appear to be competing, or could present as competing demands for financing to the G20 at the same time, when in fact there's a powerful synergy.
Yeah, interesting observation. Peter, you just answered the question. I don't know whether Ingrid, you wanted to say something on that. Go for it.
So I'd say that it needs to be an integrated part of it. So energy productivity is just a really nice phraseology for selling efficiency to corporates, but also to economic decision makers. But it is about building smart and efficient use of energy into your broader energy system. So as part of the COP21 process, countries have to do their INDCs, nationally defined contributions, and many countries now, we're working with some of them, are developing national financing strategies. And part of that is thinking through your infrastructure choices and your energy infrastructure choices. And that doesn't matter whether you're Brazil or Mexico or Slovakia or the UK. We need to be thinking about how we build smart, properly sized energy systems that have as a baseline piece the smartest, most productive use of energy, and factor in future innovations to improve that further, and then from that build out the supply side infrastructure that you need. So it has to be an integrated part of that, and I think our job is to tell the story about renewables, but also tell the story about energy efficiency and demand management as part of building that resilient energy system.
Thanks. Yeah, do you want, Peter, something on what is the alignment between G20 financing and UNFCCC financing?
So, just in answer to your question, I don't want us to get caught into what I'd call an accounting treatment question. So the COP dynamic, I think, has some healthy sides and some unhealthy sides. The amount of money going into energy efficiency investments today in the world is $300 billion per annum. With the amount of money that you raise in your question is 100 billion, a third of that, and we're calling for private sector investment to go up by a factor of 5, which means we are calling for an additional $1.5 trillion per annum to go into energy efficiency investments. A lot of that needs to come from the private sector. Now, I suppose my answer is, I think that is an enormous wave of investment flow which will happen and should happen sort of independently of the COP process, and we can be thankful for it. If it's Philips, who presented yesterday, who take money from a corporate headquarters in Amsterdam and invest it in LEDs, or their products get sold into India, that's a great flow. Those flows are going on currently. World GDP sort of is what it is. I don't think that we should get caught up in a conversation about counting the dollars and cents that move geographically in energy efficiency when the basis for energy efficiency is domestic benefit. So energy efficiency benefits those economies where those investments are made. They benefited in terms of increased productivity, increased competition, increased energy security, multiple benefits, improved public health in cases, improved buildings efficiency, improved infrastructure, faster arrivals in destinations through transport, et cetera, et cetera. So I guess my answer to the question is, I'm interested in energy efficiency as to how much of the 100 billion is potentially used for that, but I think there's a bigger question, and I'm much more interested in how we answer the bigger question.
I'm sure that's worthy of a debate, I think, that answer there, which unfortunately we haven't got time for. But the question with the second most votes on Pigeonhole, I'm going to ask this of Gregor, actually. Could you just succinctly say, and let's do this as a 1, 2, 3, what are the principal barriers to investment? So the question here was efficiency should be a win-win for investors. What are the principal barriers? So just give me your top 3.
The first one and most obvious one is that projects that are investable, a pipeline of projects, is not forthcoming. The second is that there's often insufficiently clear or draconian regulation to force people to do it. And the third one, which is common to every bit of energy efficiency technology, is the project size is very small. And in order to get financiers involved at scale, which means they're going to invest at lower rates, you need to aggregate projects.
What a concise answer. How about that? I couldn't have asked for more as a moderator. Okay, I'm going to end with a little bit of fun for my panel, which I haven't actually warned them about. So I'm going to throw you a bit of a curveball. If you could talk to anyone in order to progress the energy productivity financing agenda, who would you talk to and why? Who's going to take that first? Benoit.
I'm happy
You
to
look
take
poised to answer. Brilliant.
In order to move the million, the trillion that we need to see in energy efficiency, there is a series of ingredients, of fundamentals that we need to put in place. In Europe, when the Energy Efficiency and Finance Institution Group, EFIC, was put in place, and organizing a dialogue with policymakers and financial institutions, the conclusion from the group, from the financial institution, was a request for government to do more in terms of policy framework, in terms of setting the right instrument, putting in place the right institution to support energy efficiency. And my problem, one of the problems I see is that I don't see enough public funding going to this type of support. If we want to make energy efficiency happen large scale, we need to put in place the fundamentals. And the fundamentals is to make sure that energy efficiency is well understood, that there are some people who are able to handle that in every organization, in a bank, in an investment fund, in any company. There is, the government also has to put some standards, some certification scheme, some rating scheme, and so on. The more we do that in a harmonized manner, the more likely you can bring some visibility to energy efficiency. Energy efficiency consumes lots of data. You know, the failure of the Kyoto Protocol was no one wanted to pay for the baseline setting. Some people were willing to pay for the greenhouse gas reduction, you know, the CER, fine. But it was impossible to find some money to set the baseline. And that's exactly what we are missing in the field of energy efficiency.
I'm going to take moderator's prerogative. But who? Come on, you can name the institution. You don't have to name the individual. Who, if you had 5 minutes?
The Prime Minister and the Finance Minister. They have not yet understood the beauty of energy productivity, the dynamics that we can bring to the world economy. And we don't need to convince the environment minister or the energy ministers. We have to convince, indeed, those where the money is. But above all, I would like to convince the Minister of Finance to allocate some public funding to put in place the ingredients, the fundamentals. And then we're going to see, following the principle, the statement that we're pushing, we're going to see the big scale-up.
Okay, perfect. So the next panelists have to be quick because we're running out of time. So institution, and very quickly, why?
So I was thinking, the person is the Pope. In fact, the person is the Pope's encyclical writer, because I think that if there's been a motivation, a popular motivation, which has brought additional focus to the challenge of climate, it's come from that. It sounds a little flippant, but my intention is that we need a movement to stop wasting energy and to start creating energy efficiency investment opportunities. That needs to come from the bottom up, as Gregor has said, and I think that our politicians, which really is where a lot of this conversation is currently lying, need to hear more of a popular consensus that energy efficiency is important and is a priority.
Thanks, Peter. Gregor.
Okay, very quickly. Energy storage, 12 months ago, nobody had heard about it, and suddenly Elon Musk with the Tesla Gigafactory made it sexy. So I think we need to make energy efficiency sexy, and in order to do so, you need to do it with brands that people use every day. So CEOs of Google, Apple, perhaps Samsung, those are the types of companies that you need to get involved.
I love it. We've got the Pope and sexy mentioned within a minute. Fantastic. Ingrid.
I've got two targets, the finance ministries and the central bankers. The finance ministers to have a conversation about CapEx plans, so budget priorities, and the central bankers to talk about whether we need to be thinking about energy productivity indicators.
Excellent. And on that note, I think we're out of time. So I'm certainly feeling more optimistic about what can be done. I think there are some pretty powerful decision makers who are looking at the issue of energy productivity financing. There are some serious amount of finance that's being represented in these various statements that are currently being drafted. We'll all keep a watchful eye on what's going to come out over the months ahead. Thank you very much for your continued good work. Ladies and gentlemen, let's thank the panel.